chat. Where'd it go? Hello. Sorry, I'm trying to figure out this chat thing. I'm trying to figure out how to stream and also have the chat available. Hello. Sorry, I'm trying to figure. How's it going, Jim? How's it going, Robbie? Just waiting for people to get in, if anyone's going to join. What's up, Cass? I need to figure this out. Hold on a second. Pop out chat. There we go. I think that's better. I need everyone to tell me how the stream looks and how I sound. Is the audio good? Is the video good? Can you see everything on the screen very clearly? Have I ever seen this kind of volatility? Yes. Thank you, Jim. Sounds good. This is my second live stream, so I'm trying to figure out how to do it with higher quality. The first one I did, the video posted at 720p, and when you go back and watch that recording, it's not good enough because 720p, you can't really see all these numbers. So, am I cold today? Yeah, yes, it is. I live in Denver, so it is cold. I do wear the hat too because I'm bald and I don't have any hair to keep my head warm, so I like the hat. Have I ever seen this kind of volatility? I think earlier in 2020, in March of 2020, that was the highest volatility I have ever seen. And I know that because we got VIX up to almost 90. And so before then, the highest volatility that I had ever seen was 2015. And we can see 2015. Oh, shoot. Wow, that's more than 5 years ago. Time's flying. It's scary. Let's see, 2015. So this is 2015. The VIX got up to, actually, no, that's not 2015. That's 2015. Yeah, VIX got up to 55 in 2015. That was the highest volatility period that I had ever seen. And I learned a lot of lessons in August of 2015. And I also learned even more lessons in March of 2020. So yes, March of 2020 was the highest volatility I had ever seen. But recently, it's been more normal. Actually, I was looking at this. This is kind of an interesting starting point for the stream. If I go to a weekly, or let's see here. If I go to a weekly chart of the VIX, we can see that we are in a different market environment right now than what we have seen in the past. So if we look at just this line that I have right here, this is a VIX of 20. So we can see that basically since the start of 2020, the VIX has been above 20, and that's pretty abnormal. This is what we would call a high volatility or sustained high volatility period. Normally, you can see that the spikes of the VIX are pretty outrageous, and then it kind of trickles back down and eventually finds its way back to sub 20 levels. But now we can see that we are in a sustained period of high volatility, and that makes sense because, for one, we're seeing a ton of intervention with the government. We're in the middle of a pandemic, which we've never seen before, at least in my lifetime. And so there's just a lot of uncertainty in the markets. The markets have been insane. And so it's normal to see a different market environment, given the world that we're living in right now. We're living in a unique world, so we're going to have a unique market. You have a TD Ameritrade account and it won't let you buy debit call options. So you can't buy call spreads. Well, then you have to just buy calls or puts. I don't remember how TD has their structure, but they have a tiered options trading privilege structure, meaning that there are different tiers that allow you to trade different strategies. And so that just means that your account is not equipped to buy spreads, which is interesting because spreads, if you buy a spread compared to just buying that long option in the spread, it's actually more risky to buy the option all by itself as compared to buying a spread. So you have to essentially apply for higher options trading privileges at TD, and then once you get to the higher tier, then you'll be able to trade more strategies. Thank you, Scott. Would you continue to buy calls when the VIX is this high? Are you asking about buying calls in the VIX or buying calls in general in stocks? Have I used interactive brokers? I have not. From what I've seen, IB is not very user-friendly. It's not like a trading platform like TASTYWORKS. It's a lot more complicated in terms of navigation and usability, but they have really great commission rates. So if you're a really serious trader, especially if you trade with really large size, I think IB is a good option. But I've never used IB. I'm not sure anything more than I just said right there. So what I want to do is I want to pick a couple topics to focus on as opposed to just random questions the whole time. I would like to focus on a few topics, and then when I post the stream, I can say that the stream is about specific topics. So let's everyone start suggesting topics that you want to discuss today, and then we can take a stab at them. Entering an option at the right place, scalping. Closing illiquid spreads. That's a good question. Picking credit spreads in a vol market. Locking in profits on options. Locking in profits on options. Okay, I'm going to start there because I can show an example within this account that I have traded in Tesla. So I don't know if you guys saw my video many months ago. I did two videos called How I'm Trading Tesla Options. And in the first video, or one of the videos, I described some trades that I made. And one of the trades that I made was I put on a risky position, which was purchasing a long dated call option in Tesla. And then very shortly after I made that trade, literally the same day, probably 30 minutes later, I was able to sell or short a higher strike call option for the same exact price that I paid for the first option. And that's because I bought the call, then Tesla stock price shot up, so I had a big profit on the first call. And then since the move was so fast and so exaggerated, I actually looked at a higher strike call and I sold a higher strike call for the same price that I paid for the initial call option. So this is one of my favorite things to do when purchasing options outright, is that if the position becomes profitable, you're now in a position to completely eliminate or heavily reduce the risk in that trade. So the trade that I made is right here. So we can see that 141 days ago, based on this days open column, 141 days ago, I purchased the June call option in Tesla with a strike price of 700, and this option had over 600 days to go when I purchased it. I paid $118 for this option. So the actual cost of the option was $11,800. And then shortly after, Tesla stock price shot up. So I had a big profit on this call option almost immediately. And then I went to the 800 strike call option in the same exact expiration, and I was able to short this option for $118. And so what that did is it gave me a $100 wide call debit spread, meaning I purchased a lower strike call, shorted a higher strike call, and that creates a spread. But since the entry price for both of the options is the same, I have an effective entry cost of $0. So that means that since I paid $11,800 for the 700 call, I had a maximum loss potential of $11,800 on this call. But then later when I shorted the 800 call for $11,800, I had a maximum profit on this component of $11,800. And so basically what that means is that if Tesla were to be below $700 when these two options expire, I would lose almost $12,000 on the call that I purchased, but I would make almost $12,000 on the call that I shorted. And so there is essentially no risk in this position based on my entry cost. The only risk that I have in this position is giving up the profits that I have right now. And one way I can do that is if I highlight both of these options, right click, if I hit close position, this will bring up an order to potentially sell this call spread. So that's how I set up an order to close this position, which would be selling the 700 call and buying the 800 call. And so I could do this right now, and I could sell this spread for $35. And we can see that my maximum profit here says $34.60. So it's jumping around a little bit. I'm just going to lock the price so it doesn't move. But if I sold this spread for $34.60, my profit would be $3,460. And that's because it's currently trading for $34.60, and my effective entry price was $0. So the only thing I could lose is my profit on this spread at the moment. But if both options were to go to zero, effectively I would not lose anything relative to what I paid and received for each component in the spread. So does that make any sense? So if you ever buy an option, so if you buy a call or put and then it becomes profitable, you can short another call or put option against it to create a spread. And if you can do it where your net entry cost is zero or even positive, then you will effectively eliminate all the risk and you can continue holding the position without closing it. So right now this spread is worth $35, but the maximum value that the spread could be worth at expiration is the difference between the strike prices, which is $100. So if Tesla is above the higher strike call, which is 800, if Tesla is above 800 when these options expire, this 700, 800 call spread will be worth $100 or having a value of $10,000. And therefore, based on the difference between $10,000 and the current value of $3,500, I can still make another $6,500 on this spread. And all that has to happen is Tesla needs to stay above $800 through the expiration, which is 500 days away. Is it possible? Well, hold on. Let's see here. All right, this is a good one. do you trade full time? What are your other streams of income apart from trading and YouTube? So I have 2 income streams. One is YouTube ad revenue. So I've built a YouTube channel in options trading, and the more views I get, and the more time people spend watching my videos, the more advertisements people see, and advertisers pay YouTube to put their ads on YouTube videos. And so YouTube collects the ad revenue from the advertisers, but since YouTube is using my videos to put those ads on the YouTube platform, and I'm the creator of the videos, YouTube pays the creator a percentage of all of the advertising revenue that they receive. And so that's revenue stream number 1, is YouTube ad revenue. The second revenue stream is the affiliate marketing that I do for TASTYWORKS. So I use TASTYWORKS, and you've probably seen in my videos where I offer, if you sign up with TASTYWORKS, you fund an account, and you use the project option code, it's a phenomenal way to support the channel and support what I do, because essentially if you sign up and fund an account and use the project option code, then I get compensated for that. But the beauty of that is you don't have any direct cost. So you're not paying me to actually receive some sort of benefit. You are getting connected with a brokerage firm that has really good commission rates and a really solid platform. And for that, if you use my referral code to support the channel, I get paid for that because TASTYWORKS sees that I generated an account for them. And so I love it because instead of selling trade alert subscription services or selling courses, which I do have a course on my website that you can buy, but it makes up a very small percentage of the money that I make from YouTube. I knew somebody was going to notice the Ableton Live. 1,000 Memories. Yes, I'm taking a music production class right now through January, and I'm having a lot of fun with it. I've always enjoyed electronic music, and making music is something that I'm trying to get into. It's a lot of fun. I'll let you know when I have some finished tracks for you. Yeah, so Factor, the first one was YouTube. The other one that's not YouTube is affiliate marketing. That's it. Let's see here. Looking at these questions, trying to figure a good one. LEAPS or stocks? Someone keeps asking LEAPS or stocks. So they're saying, do you buy shares of stock or do you purchase a long-term option on that stock to get exposure to it? And I really do like the long-term. Let's just go to something that's not super risky like Tesla. Let's go to the S&P 500. So instead of buying 100 shares of SPY, if you could afford that, if you bought 100 shares of SPY, it would cost you $38,000, and you would make and lose $100 for each $1 change in SPY. So instead of doing that, they're saying, should I buy LEAPS instead? So a LEAP could be going to the January 2023 expiration cycle, and this option cycle has 731 days to go. And they're asking, could I buy a call option in a long dated expiration cycle as opposed to just buying shares of stock? So this is going to be a higher risk strategy because if the market falls or doesn't increase over this trade duration, then you're going to lose a lot of money, and you could lose all your money just buying the call option. But if you bought shares of stock and the stock market fell or even stayed neutral, like you're going to have some residual value in that position. And over a long period of time, it's very likely that you will at least make back your money depending on the holding period. Historically, the longer you hold a position in a broad stock market index like the S&P 500, the higher the probability you have of making money. So that is a safer play, but you don't get a lot of leverage. And so instead of buying 100 shares of SPY for $38,000, maybe you go to the January 2023 expiration, which has over 2 years to go. And then you go to, let's say, the 450 call option. So one thing you could do, you could purchase the 450 call. And we can see that if you bought one of these call options, you would have a maximum loss or cost of entering this trade of $1,200. And so you can buy a lot more of these call options for $38,000 compared to just buying 100 shares of SPY. So if we look at the delta of this call option, it says 26. And this means if you buy this call option and SPY goes up $1, you're expected to make $26 from this position. So remember, if you buy 100 shares of stock and the stock price goes up $1, then you will make $100. So buying 100 shares of stock has a delta of 100, meaning your profit or loss sensitivity is 100 with each $1 change in the stock price. So to get 100 delta from this same call option position, I could buy 4 of them. And if I buy 4 of these 450 calls in the January 2023 expiration, my delta is 105, which means if I buy 4 of these calls for $5,000, I'm expected to make $100 if SPY goes up $1. And so I can get the same directional or profitability exposure with $5,000 as compared to buying 100 shares of stock for $38,000. And so you get a lot more leverage when you're trading options. Like if you wanted to just crank this up, you could buy 25 of these options for 30 grand, and now your delta is 650. So you're paying less money overall to buy these options, but your delta is 6.5 times larger than it would be if you just purchased 100 shares of stock. And so if you decided that instead of putting 30 grand into shares of SPY and you wanted to put 30 grand into long dated call options in SPY, then you could get a lot more bang for your buck. So if you bought these options, SPY goes up $1, then you would effectively make $600 to $700. However, if over the next 2 years, SPY does not really increase that much and is below 450 when these options expire, then you just lost 100% of your investment, and that would be a much larger percentage loss compared to if you purchased 100 shares of stock and let's say SPY went from 380 to 410 over the next 730 days. You would make money on the share position, but you would lose 100% of your money on this option position. And so my answer to should you buy LEAPS or buy shares of stock, I think you should have a combination of both. I think with a smaller percentage of whatever you're willing to risk, you can put it into something like this, but I would not recommend putting 100% of your investment portfolio into a position like this unless you are really young and you make a lot of investable income each month and you're willing to take that risk. If you're young and you have a long-term investment time horizon, and you have a lot of investable income that you can invest each month, then I think higher risk plays like this are actually smart because you can take higher risks and you can grow your account much faster. And then once you grow your account, you can kind of scale back and go to lower risk strategies. And the lower risk strategies with a higher investment portfolio or a larger investment portfolio, that is going to be a good strategy over time. So I think there is a place for sure for buying long-term out-of-the-money options in things that you believe will go up over time. And you don't have to necessarily use this strategy on a broad market index like the S&P 500. You could do it, as I've done, in a super speculative stock like Tesla, which clearly, for me, has worked out incredibly well over the past few months. So actually, I forgot to mention something earlier. So not long ago, let's see, 120 days ago, I purchased another out of the money call option in Tesla. I purchased the 900 call with 700 days to go, and I paid $10,000 for that option. So the trade price is 101.30, which means I paid $10,130 to buy this call option. But then 11 days ago, after this 900 call option was already extremely profitable, I went to the 1500 call in the same exact expiration cycle, and I shorted it for $23,000. So basically what that means is if both of these call options expire worthless, I'm going to make $13,000 because I paid $10,000 for the 900 call, but I turned it into a spread by shorting the 1500 call for $23,000. So my net entry price for this spread is effectively a $13,000 credit. So the best case scenario is Tesla keeps going up and is above 1500 in 700 days. But the worst case scenario is if both of these options expire worthless because Tesla is below 900, then I can effectively still make money because my entry price for this spread is a credit of $13,000. And it's not a credit spread, meaning I took risk and I don't want Tesla to go up. Since I bought the call option first and then I shorted a higher strike call later on, and my net entry cost for this is a credit, I can't lose any money on this trade. And the reason I did this secondary trade, the reason I shorted this call option, is because it reduces my bullish exposure in Tesla. So if we look at the delta of the 900 call, we can see that it's positive 68, which means if Tesla goes up $1, I lose $68 on this option. If Tesla goes down $1, I lose $68. And so I wanted to reduce my bullish exposure in Tesla, given that these positions have been so profitable and I want to protect them from going back to zero. And so by shorting this 1500 call, we can see that the delta of the 1500 call is negative 51, which means if Tesla goes up $1, I will lose $51 on the short call. And if Tesla goes down $1, I will make $50 on the short call. And so what if we combine these two? What that means is that the delta of this spread overall is about 18. So if Tesla goes up $1, I'll make $68 on this option. I'll lose $50 on this option. Net net, I make $18. And if it goes down by $1, I will lose $68 on this option. I will make $50 on this option. I lose $18. So if we ignore the short call portion and we just look at the long call portion, instead of making or losing $68 for a $1 change in Tesla, I turned the position into a spread, which will make or lose $18 with a $1 change in Tesla. And so this was a defensive trade that I made, and I basically locked in a guaranteed profit on this spread, and I also reduced my bullish exposure in Tesla, which is something I wanted to do because I didn't want to get greedy and I wanted to be smart. The number one rule is to always protect your profits whenever you can, especially when it's a position that is highly concentrated because it has been so profitable for you and you've already seen it grow into such a large position, and you do not want to see it go back to the initial starting point because that's just going to suck. So this was a defensive mechanism, but hopefully that explanation helped you understand how you can lock in profits on long options and also how it changes your directional exposure in that position. Jim asks, what if Tesla is between $900 and $1,500 in 700 days? So that's a good question. And the value of this position will depend greatly on where Tesla is, because right now Tesla is below both of these options, these call options, and therefore both of these call options have no intrinsic value, which means at expiration, if Tesla is at 840, then these options will expire worthless, and I'll just essentially make the $13,000 that I can make because I essentially bought this call spread, but I bought it in 2 separate transactions, and my entry cost is actually a credit, meaning I can't lose money on this portion of the trade. And so if Tesla's below 900, then I make 13,000. But let's say Tesla goes to 1,200. If Tesla's at 1,200 in 700 days, then the 900 call will have $300 or $30,000 of intrinsic value. The 1,500 call will go out worthless, and that would be a really good situation here because I would effectively, well, let's see here. My entry cost is a credit of $130. If Tesla's at $1,200 in 700 days, this spread will be worth $300 or $30,000. So I'll have a position worth $30,000. I collected $13,000 to get into it. So therefore my profit at that point would be $43,000 if Tesla were at 1,200 in 700 days. So the value of this position greatly depends on where Tesla is. The maximum value of this spread is the difference between the strikes, which is $600, meaning that this spread could be worth a maximum value of $60,000. And currently it is worth $11,000. So there's a lot of money that could be made in the spread if Tesla continues to go up. But like I said, I can't lose any money on this spread because I entered it for a credit. I essentially purchased it and received money for entering it. How do you determine the allocation for a strategy? That's a good question. And I think it really comes down to the time frame of the strategy. So I think if you're trading options, you're buying options super short term, like you're buying 7-day options, you should not be putting 20% of your account into a 7-day option play. Because if everything does not go right for you, then you're going to lose 20% of your account in 7 days. However, if it is a position like we talked about earlier, which is a little bit more conservative and much longer term, which is going to a SPY call option and buying some out of the money calls in the 700-day expiration cycle, if you want to put 20% of your investment account in this position, that's much better than putting 20% of your account into a 7-day highly speculative gambling options play. Because if you did this strategy, we all know that over time, the market has a higher probability of going up than down, especially over a 2-year period. So you're actually making much less of a gamble with this position, but it is still highly risky. So I'm not recommending that you put 20% of your account into it, but the difference between this option play and something like buying a 7-day option in Tesla is that everything has to go right with the 7-day option play. And therefore, since everything needs to go right, you should size that position much smaller. And also with the shorter term option purchases, you can see much larger increases in the value of that position in terms of percentage increases compared to this more expensive longer term option play. So I think the shorter term you go, the shorter term you're trading, the smaller the position size should be. The longer term the trade is, meaning the more time you have for things to work out, the less likely it is to blow up instantaneously. I think the larger you can go with your position size. But it also comes down to conviction too. Like I was comfortable putting a lot of money at risk in Tesla just because the sentiment was there and I believed in the vision. I'm not saying that the stock price right now is justified or that I expected it to be here, but I was more comfortable putting a lot of money at risk in Tesla compared to something like buying call options in Lemonade, which I don't know anything about. Okay, so it comes down to, I think, time frame, conviction, and honestly, like conviction doesn't mean that you're gonna have a higher probability of making or losing money. But I think that if you have a higher conviction play, then sure, if you want to put more money at risk, then I think that's okay. So that's the start of my answer. But I think generally speaking, when we're trading options, you don't want to put a high percentage of your account at risk. So if you're going to put a higher percentage of your account at risk, it should probably be a longer term play. Maxwell M, how did you enter for a credit? Yes, I legged in. So if we look at this position, we can see that I bought the 900 call 120 days ago, and then I shorted the 1500 call 11 days ago. So I had on this naked 900 call purchase for 110 days, and then I had a massive profit on this position, and that's what allowed me to short the 1500 call for a much higher price. Because since the stock price increased so much, the 1500 call's value actually increased immensely as well, and that allowed me to short the 1500 call for a higher price than I paid for the 900 call initially. So yes, you have to put on this type of position, you have to leg in, meaning that you have to take the risk of a standalone option purchase by itself, and then you need to see that option purchase become profitable before you are able to leg in and create a risk-free position or a guaranteed profit position, as this is. How do you feel about penny stocks, and do you recommend any? I don't like penny stocks. I think you should stay away from penny stocks. While we're talking about penny stocks, it's worth mentioning, and you guys probably know this, but the investment and trading industry is highly predatory. And if you see articles or services that are pitching you make huge returns by trading penny stocks, I think you should exercise some caution there. I'm not saying that people don't make money trading penny stocks or doing short-term option plays or whatever it is, but the vast majority will not make money. It's going to be a very high risk activity, and I think you should be very careful. There was actually, I'm not going to name any names, but there was an options alert service recently that got into hot water with the SEC for defrauding investors, and they were a advisory service, so they basically sold trading subscriptions. So you paid them a monthly fee, $100, $200 a month, whatever it is, and they would give you option plays. And they did that for years. They made a killing. They made $140 million from their revenue. $140 million selling trade alerts services. And then the SEC started to get involved and found out that they were making very exaggerated claims, and tons of people filed complaints against them because they weren't actually delivering profits on those trades. So they were making all their money just collecting money from people who wanted to get rich quick, and they didn't deliver, and they made exaggerated claims, and now they're not in good shape. So that's just a word of warning. M. Telia has a good question. Hey Chris, can a non-directional trading system make better returns than a directional trading system? So a non-directional trade would be something like a short iron butterfly, which somebody asked about earlier. So I guess I'll queue up the short iron butterfly. So a short iron butterfly is essentially when you sell a call spread and sell a put spread. So you're doing a put credit spread, a call credit spread. The short strikes are the same. So the short strikes are the same, and you're basically connecting the put spread and the credit spread, or the put spread and the call spread. So if Apple's at 128, a iron butterfly would be, an example would be selling or shorting the 130 call, buying the 150 call, shorting the same strike put, which is the 130. So shorting the 130 put, and then going, let's just do we call it equidistant iron butterfly where the distance between both spreads is the same. So since I used a $20 wide call spread, I will go $20 wide for the put spread as well, which means it'll be the 130, 110. So if we queue this up, we can see that the price is $12. So the most you can make for this iron butterfly position is $1,200. The most you can lose is $800 because the maximum value that this spread could be worth is the distance of the widest spread. And since the spreads are both $20 wide, if Apple is below 110 or if Apple is above 150 when these options expire, then this iron butterfly will be worth $20 or have a value of $2,000. And if I short it for $1,200 and it goes to $2,000, then I will lose $800. The maximum profit is $1,200, which is only possible if Apple ends right at 130 exactly at expiration. So in 59 days, Apple has to be right at 130. And if it is, then all of these options will expire worthless. The iron butterfly will have a value of $0, and you will effectively keep the difference between what you shorted it for, which in this case would be $1,200, and 0. So if you short it for $1,200, goes to 0, you make $1,200. The problem with this is you need Apple to stay in this range, and you need Apple to essentially be very close to 130 when the options expire in 60 days. And the profits on this position are going to be very, very slow if that does happen. So if Apple stays right at 130, this short iron butterfly position is going to go from $12 and the value is going to shrink. And it's going to approach $0 if Apple is right at 130. So this would be a non-directional trading strategy, meaning that you're making money when Apple stock is not moving around a lot. And so compared to a directional trading strategy, this trading strategy has a higher probability of making money because the stock has this range that it can fluctuate in and you can still make money. However, the max profit is $1,200. The max loss is $800. So the risk to reward here isn't that great. And so compared to a directional strategy, say purchasing the 130 call for $650, if I bought this call, the most I can lose is $650. But if Apple shoots up to 150 by the expiration date, which is March 2021, then this 130 call would be worth $20 and you would effectively triple your money. So you can make a lot more money directional trading compared to non-directional trading. There are pros and cons to each approach. The benefit of non-directional trading strategies is that you don't need the stock price to move big in either direction. You just need it to stay within a specific range. But that is also a prediction. So it's not necessarily easier than making a prediction that Apple will go up or down. But it is technically a higher probability play because if I buy this 130 call, which is a very directional strategy, and if I pay $670 for this option, I need Apple to be at 136.70 when it expires to just break even. But if it goes up a lot more than that, then I can make a lot of money on this trade. So I would say you can make a lot more money directionally trading, but you need to be right about the time frame and the direction and the magnitude of the direction for you to make money when trading directionally. And so I think it is easier to make money with neutral trading strategies, but still, just because you can make money when it's in a range and it doesn't need to go up or down in your favor, it still is a prediction, and it's just not as bold of a prediction as saying I think Apple is going to shoot up or Apple is going to collapse over the whatever, how many days. So I think you can make more money trading directionally. I have made a lot of money in the last year trading directionally, but I think there's a place for both in your portfolio. For non-directional strategies, I typically prefer a non-directional approach in a stock market index product like the S&P 500. Hmm. Let's see here. Do you use charts or no? I don't really. I look at charts just to get an idea of kind of what's going on. Let's change this up here. Daily, 1 year. Like, if I look at this Apple chart, basically, if I look at this Apple chart, I would prefer to have a bullish strategy in Apple, whether that's just putting something on now or waiting for a dip and then being confident that the market sentiment for Apple is so strong and everybody loves buying Apple that if Apple were to come down, then it has a high probability of bouncing. Obviously, that's a prediction. It's not guaranteed. But if I look at this chart, I am thinking that it's a bad idea to put on a bullish trade, just because if you look at this period, there are very few periods in here where if you bet against Apple, you would have made money. So I think the higher probability, just based on this pretty steady trend, is to do a bullish strategy. But I'm not going to ever claim that I'm a technical analyst or that I follow any indicators. I just look at charts very simply, and like I just described, like if I looked at this chart, I would say, yeah, I'd probably not want to bet against Apple. And if I wanted to bet against Apple, then I probably would just do nothing, which is another skill that I've kind of learned trading, is that whenever you think you want to do something, like a lot of times you don't necessarily have to make a trade. And I think it's a very valuable skill to exercise some discipline and learn how to not do anything, even when it looks so good. Like just based on this, like you'd think I could just buy a call and make money. I could buy a long dated call in Apple, probably make money, but I'm not going to do that right here just because I don't want to force a trade right now. So I look at charts very loosely. I think some products do trade very technically. Like if you look at the S&P 500 futures, it's a very technical product, because I think there's a lot of traders out there who are professional that trade this product technically. And so I think there are products that tend to trade a little bit more technically than others. But I'm not going to ever claim to be a market technician or technical analyst or whatever. So I think it's good to get a general idea of what's going on with the stock. And I mean, if we just jump around here and look at different stocks, we can kind of see what's going on. I mean, everything's basically been going up. Obviously, Tesla has been going to the moon. Square, all the tech stocks are kind of moving together, just going straight up. But then if you look at a stock like Nvidia, so when I see this chart, right away I'm thinking, okay, this could be an interesting candidate for a neutral strategy, because you have this defined range here that's been going on for quite some time now. Obviously, it could break, it could go down, it could go up, it could break through. But immediately when I see this chart and I see the last few months of trading, I'm thinking, all right, I could potentially set up a neutral strategy on this if I wanted to. And what I would probably do is I would probably try to do some sort of butterfly strategy where the short strike is somewhere in the middle of this range. So that would be like 540 or 550. So if we go to Nvidia and we do a 60-day play, let's go to the 550, short the 550, buy the 600, short the 550 put, buy the 500. Like this would be an interesting neutral play for me. However, they probably have earnings, which is another thing that could be a catalyst for them for sure. So yeah, earnings. It says earnings are on February 11th. I'm not sure if that's confirmed. So this would be risky, because you'd be putting on a play that does include earnings. But if I were to look at this chart and say, what would I do based on the chart, then I would probably lean towards a bullish strategy. So I would sell a put spread, just because I do like Nvidia. I do own some shares of Nvidia. I would rather do a bullish play than a bearish play in this. But if I were to go neutral, I do like how the chart looks for a neutral play. But as I said before, just because that's what the chart's saying doesn't mean that trade would make money. But that's that's very loosely how I approach looking at charts and setting up trades. Let's see. What Greeks do you use to time an entry? I don't use Greeks to time entries. I just use Greeks to analyze the position, as I did earlier with this Tesla position. I was talking about the delta of this call option and then the delta of the next call option that I shorted against it. And I talked about how I changed the directionality of that position. Jeez, come on. I changed the directionality or the directional exposure of this position, and I use delta to explain that. So I don't look at delta necessarily as a predictive indicator. Delta is one of the option Greeks, and all the option Greeks tell us are estimations of profitability given changes in certain things. So delta tells us the estimated profit or loss of an option position based on a $1 change in the stock price. And then if we move on to gamma, it tells us the expected change in our delta given a $1 change in the stock price. Theta tells us the expected profit or loss on our option position based on the passage of 1 day. And then Vega tells us the expected profit or loss of an option position based on a 1% change in implied volatility. So these are just, they're like the gauges on your car. They tell you what things are. They don't necessarily predict anything. I mean, you could use delta to predict the probability of expiring in the money or out of the money. So for example, if we go to Apple, go to February, the delta of an option is a rough estimate of its probability of expiring in the money. So for example, the 140 call has a delta of 0.24, which means that over the next 31 days, there's roughly a 24% probability that Tesla or Apple will be above 140. So delta is somewhat of a proxy for the probability of an option expiring in the money. And if we go to the 128 call and 128 put, we can see that the 128 call, the delta is 0.52, meaning that there's roughly a 52% chance that Tesla or Apple is above 128 in 31 days. And then on the put side, it is 0.48, which means there's an estimated probability of 48% that Apple will be below 128 in 31 days. So that's how you can use the Greeks to predict things, but that's not, I don't really read too much into the delta and probabilities. It's just a rough estimate. Thank you, Giovanni. Glad to have you here. What is the best strategy? How small of a bid-ask spread do you need for an option? That depends on the stock. So higher price stocks have more expensive options, and more expensive options will have wider bid-ask spreads. So if we look at Apple, the February Apple options, if we look at the 128 call and put, actually let's go to the 130. So the 130 call has a bid-ask spread of 10 cents, and this option is worth $4.75. The 130 put has a bid-ask spread of 10 cents, and the option is worth $7. If we go to Amazon, by the way, these are really good bid-ask spreads. So Apple is a good stock to trade. I would stick to the round number strike prices, because if you look at the open interest here, and also if we go to the volume, if we look at the, I don't want to do that. Back to Apple. If we look at the volume and the open interest, we can see that all of the trading activity is in the round number strikes. So 115, 120, 125, basically the strikes divisible by 5. So I would stick to trading these strike prices because you're going to have an easier time getting in and out of your trades. And I would avoid trading things like the 132 call, the 133 call, because we can see there's not much activity here. There's no open interest, low volume. But if we look at the strikes divisible by 5, then we can see that there's a ton of options trading activity in these strikes. So that's a pro tip, is not just look at the bid-ask spread, but look at the open interest in the strike prices and gravitate your strike selection to the strike prices with higher open interest. Getting back to the examples, if we go to Amazon, Amazon is a $3,000 stock. So if we open up the February options and we go to the 3100 call, we can see that the bid is 144.40, the ask is 145.40. That's actually really good for an option that is worth $140. That's really tight. And that's because Amazon's a popular stock, and so there's a lot of trading activity. If we go to, let's go to SPX. That's pretty good too. Let's go to, this will be more interesting. Let's go to the Russell 2000 options. So if we go to the 2150 call, we can see that the bid is 92.30, the ask is 93.90. So this is getting wider. So it's a really hard question. What bid-ask spread do you need for trading options? It really depends on the stock that you're trading, the stock's price, and how popular it is. I would just stick to trading popular stocks that have really active options, such as, you know, all the hot names like Facebook, Microsoft, Apple, Tesla, Nvidia, JP Morgan. Just stick to companies that are well known and always look at the open interest and the volume. And like I said, gravitate your strike selection to the strikes that have the most open interest and trading volume in general, because you'll have an easier time getting filled on those options compared to trading the lesser traded stocks and options. No super chat? No, but I should look into that, huh? All right. I think that's going to do it for today's stream, guys. Everyone, guys and girls. Thank you, everyone, for coming in. I had fun. I think we answered a lot of good questions today. I'm going to have to go through and for the stream upload to the channel, I'm going to try to have timestamps in the description and on the playhead so that you can neatly go through the different video sections that we talked about today. All right. I'll see everyone later.